In finance, everyone's talking about machine learning, but almost no one's doing it right. Billions are being poured into AI strategies that fail, not slowly, but spectacularly. Why? Because they're still stuck in the Sisyphus paradigm, lone geniuses pushing broken models uphill. But the firms that win? They build research factories, precision-engineered, specialized, scalable. In this deep dive, we reveal the real blueprint behind ML success in finance, from information-driven data and meta-labeling to fixing backtests before they ruin your strategy. This episode could save your next ML project. Don't be the last one in the room to get this. Listen to the full podcast now, available wherever now in our YouTube channel, The Deep Dive, Financial ML Unpacked.
Welcome to The Deep Dive. Okay, so you probably heard a lot about machine learning in finance, right? See the headlines, maybe picture these algorithms making perfect predictions like lightning fast. But here's the truth. What does it really take to succeed? I mean, in this intensely competitive, often kind of unforgiving arena, it's way more nuanced than just plugging in some code you found somewhere. Today, we're going beyond the hype, beyond the superficial stuff. Our mission to really embark on a deep dive into the foundational concepts, the things that genuinely separate winning ML strategies from those costly, disheartening failures. We're going to directly confront the complexities. Financial data, the markets themselves, and hopefully give you a kind of roadmap to understanding it all.
Yeah, it's fascinating because let's say, conventional wisdom, it often falls remarkably short in this space. It really does. You have these brilliant mathematical theories describing a financial world that, well, it just doesn't exist, not really. And then just as often, you see practical applications that lack the rigorous grounding they desperately need. So our whole focus today is bridging that critical gap for you. Because let's be honest, the success rate for financial ML projects, especially if you're kind of new to the field, it's remarkably low. We're here to explain why, and maybe more importantly, how you can beat those odds.
Okay, here's where it gets really interesting. We're talking about a field where, look, if you try to go it alone, the odds are just dramatically stacked against you. One of the biggest mistakes, maybe the most critical one we see in quant finance, is what some people call the Sisyphus paradigm. Just picture this. A firm hires, 50 brilliant PhDs, right? And they tell each one, okay, you individually build us a whole investment strategy from scratch. You've got 6 months. What happens? Almost always you get one of two things. Either it's a false positive, a strategy that looks absolutely amazing on paper, but it's just overfitted to old data.
Right. Completely fooled by randomness.
Exactly. Or you end up with a, standard, really crowded factor investing strategy, something that gives you pretty lukewarm, kind of disappointing returns.
And both roads often lead to canceled projects. A lot of wasted effort, basically.
Yeah, it's like pushing that massive boulder up the hill. You know the story, only for it to roll right back down again.
Yeah. And if we connect that to the bigger picture, the successful quant firms, the ones actually making predictable, repeatable discoveries, they absolutely do not rely on individual heroes. Not at all. They operate much more like a sophisticated research factory. Think of like an assembly line, but for knowledge. Each person is a master of a very specific specialized task. But, and this is key, everyone understands how their little piece fits into the whole puzzle.
Right, the whole process.
Precisely. It's very much like a top-tier scientific lab.
Yeah.
Maybe somewhere like Berkeley Lab, which makes these huge breakthroughs pretty routinely.
Discovering new elements, MRI tech, that kind of thing.
Exactly. You don't credit just one person for those. They're the result of organized, collaborative, highly specialized teamwork.
And that structure, that research factory idea, that's precisely what we're going to unpack for you in this deep dive. We'll walk you through how to design it, conceptually anyway, by exploring the absolutely crucial components, step by step. And we'll start right at the bedrock. The data.
Okay, so let's kick off with data analysis, building that incredibly solid foundation. And it really starts with a truth that sounds simple, but wow, it's often profoundly overlooked. Garbage in, garbage out.
Right. It's absolutely fundamental.
You just cannot build robust models on flawed data, period. Truly understanding and then structuring financial data. That's where the vast majority of projects, honestly, go completely astray before they even properly start.
It's like trying to bake an amazing cake, but starting with, rotten eggs. Doesn't matter how good your recipe or your oven is. Exactly. So ideally, your starting point should be raw, unstructured data. Data that you process in your unique way to get features that are genuinely informative. You don't want to just grab someone else's pre-cooked data set. Because if you're using data everyone else has already cleaned and processed, well, you're probably only going to find what everyone else already knows.
Precisely. And when we talk about the essential types of financial data, we usually break it down. You've got fundamental data, market data, analytics. But then there's this really crucial category for getting an edge, alternative data. Think of alternative data as something, well, unique, like maybe tracking oil tanker movements before an energy company reports earnings, or using satellite images of store parking lots to gauge retail sales, that kind of stuff.
Stuff that isn't obvious.
Right. It's primary, it's unique, and often it's really hard to process. That's kind of the point. Because it hasn't been refined or widely spread around yet. That's where you can find that, elusive informational edge. Now, let's get into how we actually segment this data. What we call bars. Most people know standard time bars, like 1-minute bars, 5-minute bars,
Yeah, the default.
But here's a critical insight for machine learning. They're inherently problematic, really problematic.
Why is that?
Well, because markets don't process information at constant time intervals. Think about it. During quiet periods, time bars oversample. They give you tons of noise, basically nothing happening. Then, during crazy busy periods, they undersample. They totally miss crucial details packed into short bursts.
Okay, so it messes up the statistics.
Big time. It leads to poor statistical properties, like serial correlation in returns, meaning what happens in one bar is highly dependent on the previous one. That's bad for most ML models. And it raises this important question. If algorithms are increasingly running the market, why are we still stuck using these human-centric time intervals for our data? It doesn't quite make sense.
So what's the alternative?
Well, we strongly advocate for information-driven bars. These are designed to sync up with actual market activity. We're talking about things like tick bars, volume bars, or my personal favorite, dollar bars.
Dollar bars, like actual dollars.
Yeah, sure, pretty much. A dollar bar is formed by sampling every time a specific market value, say $1 million worth of stock, gets traded. They're a real game changer because they align with economic activity, not just the clock ticking.
Okay, that makes intuitive sense.
And the returns you get from dollar bars, they're much closer to being statistically robust, closer to that IID independent and identically distributed ideal that ML models love. It's like giving your models the market's actual heartbeat, not just a regular, but often, irrelevant pulse.
Okay, so we've got our smart, information-driven data. Awesome. Now, the next critical step in our research factory setup is telling the models what patterns to actually look for. This brings us to labeling, giving labels to our observations. And here's where another major flaw often creeps into the old ways, the fixed time horizon method.
Oh, definitely. A classic mistake.
Right. This method just labels an observation based on what happens after, say, 5 minutes. But it's profoundly unrealistic. It completely ignores something absolutely vital in the real world.
Stop-loss limits.
Exactly. Stop-loss limits. No real trading strategy profits from a position that, in reality, would have been automatically closed out by the exchange way before that 5 minutes was up. It's just, It's a fantasy scenario. And this is why the triple barrier method is such a breakthrough. It's so much smarter.
Much more realistic.
Yeah. Instead of a fixed time, it labels an observation based on which of 3 dynamic barriers gets hit first. You get a profit-taking barrier, a stop-loss limit, which cleverly adjusts based on estimated market volatility.
Crucial point, that volatility adjustment.
Right. And finally, just an expiration time limit. This makes your labels way, way more realistic, reflective of how trading actually works.
And building right on top of that, we have meta-labeling. Now, this concept, it's often misunderstood, but it's incredibly powerful if you use it right.
Okay, tell us about that. What's the misconception?
Well, the primary purpose is not to find brand new betting opportunities. That's what a lot of people think. Instead, meta-labeling acts like a highly sophisticated filter. It takes the predictions from your main model or even a trading rule a human came up with, and it helps you decide whether to actually act or just pass on that signal.
So it's like a second opinion, a check.
Exactly. Think of it as a secondary, really intelligent layer of decision-making, a quality control step. And by applying meta-labeling, you can drastically increase your F1 score. That's a key metric for model accuracy, especially when your opportunities are rare, which they often are in finance.
So what does this all mean for you, the listener? It means your existing trading rules, maybe even ones you developed yourself, can become vastly more effective, more reliable. You just add this secondary layer of intelligence.
It's about boosting the precision of your strategy.
Okay, moving through our factory line,
Yeah.
we need to tackle the issue of overlapping outcomes and using sample weights. The core idea here is that in financial data, you simply cannot assume observations are independent and identically distributed. That IID assumption, it's fundamental in a lot of basic stats, but ignore it here. It's a recipe for, well, disaster.
Precisely. Because financial data has this inherent stickiness or memory. One observation isn't truly independent of the next one. We can't just randomly pick data points for training our models like you might in other fields.
Because you'd be kind of showing the model the same information multiple times.
Exactly. It introduces bias. So we have to account for the average uniqueness of a label within our data set. How much genuinely new information does each label bring? Methods like sequential bootstrap are really clever ways to generate samples that are more truly unique for techniques like bagging classifiers.
How does that work, roughly?
Well, instead of just drawing points randomly, which might grab highly correlated or overlapping info sequential bootstrap, intelligently select samples to ensure they're genuinely distinct. This significantly improves the efficiency and, more importantly, the robustness of your models. It stops them from cheating by seeing the same underlying information just presented slightly differently over and over. You get far more reliable predictions at the end of the day.
Okay, and this brings us to something that, for me anyway, was a huge aha moment when I first understood it. Fractionally differentiated features. See, we face this fundamental paradox in finance data. Let's call it the stationarity versus memory dilemma.
A core challenge.
Totally. On one side, you have returns. They're generally stationary. Their basic statistical properties don't change much over time, which is great for ML models.
Yeah.
But they're also mostly memoryless. They don't carry much info about past trends. On the other side, you have prices. They have all the memory, all that rich historical context we want, but they're non-stationary. Their properties shift constantly, which makes standard ML algorithms struggle.
It's a real catch-22.
Right. For ages, it was like, how do you get the best of both worlds? Well, fractional differentiation, specifically a technique called fixed width window fractive, or FFD. It brilliantly resolves this. It's really elegant.
It finds the minimum amount of differencing you need to apply to make your data stationary,
While preserving the maximum possible amount of that crucial memory. Think of it like a super smart filter. Before, you either had to throw the baby out with the bathwater difference, your data completely lose all the memory, or you were stuck with this noisy, non-stationary mess. Fractional differentiation gives you this amazing control. You get the statistical clarity your models need and the rich historical context that actually drives true insight. It's genuinely transformative, I think.
Absolutely. So with that solid foundation in data analysis properly established, the right bars, the right labels, handling overlaps, preserving memory, now we can transition into part 2. Modeling. This is all about building truly robust, truly resilient machine learning systems on top of that great data foundation.
Okay, first stop here, ensemble methods.
Sure.
The basic idea, the power here, is combining multiple weak learners. These are essentially simple individual models. You combine them.
To collectively reduce both bias and variance, which is the holy grail, really.
Right? It leads to a much stronger, much more accurate overall prediction. Techniques like bagging, bootstrap aggregation, and of course the super popular random forests, these are prime examples. It's where the wisdom of the crowd really shines through.
Now let's tackle something critical. Something that, frankly, invalidates a lot of published research you might see in finance. Cross-validation.
Uh-oh. Sounds serious.
It is, and this raises an important question for you listening. If you've seen papers or models that just use standard k-fold cross-validation in finance, it is almost certain those results are misleading. Seriously.
Why does it fail so badly here?
Standard k-fold CV fails dramatically in finance because, like we keep saying, financial observations are not IID, they're not independent. This leads to a massive problem called leakage. Information from your testing set, the data you're saving to evaluate the model, it inadvertently seeps into your training set during the process.
So the model gets clues about the answers.
Exactly. It's like accidentally giving your model the answers to the test before it even takes it. It makes the model look way better in testing than it actually is in the real world.
Okay, so how do we fix that? What's the right way?
The crucial solutions, and honestly, these are non-negotiable if you're serious about financial ML, are using purged k-fold CV and introducing an embargo. Purging makes sure that any data point used to test the model in one fold is completely removed from the data used to train the model in other folds. That stops direct leakage.
Makes sense. And the embargo?
The embargo adds a buffer period. It prevents any information that might sort of bleed over time from the testing period back into the training period. It cleans up those temporal overlaps. These techniques Absolutely essential. You need them to get realistic performance estimates and avoid chasing ghosts, these costly false discoveries. Without them, you're basically flying blind.
Which leads us nicely to this pretty provocative statement you sometimes hear from serious quants. Backtesting is not a research tool. Feature importance is.
Yes. That one always gets attention.
It sounds counterintuitive at first, right? But think about it. Understanding why your model is making certain predictions. Doing that ex ante before you even run a historical simulation. That's the real research. It helps you grasp the underlying economic or market logic, the patterns your algorithm thinks it's finding. Is it real? Does it make sense?
Whereas backtesting, often it just confirms your own biases or, worse, highlights how badly you've overfitted the model to the past.
Right. And related to feature importance is dealing with substitution effects. That's basically multi-collinearity, where you have multiple features telling you pretty much the same story.
Yeah, they're redundant.
And things like using orthogonal features, maybe derived from techniques like PCA, principal component analysis, can help untangle those relationships, show you the truly independent drivers.
And when you're ready to really fine-tune your models, make them perform at their peak, we turn to hyperparameter tuning. Again, using proper cross-validation.
So not just picking settings randomly?
Definitely not. Now, methods like grid search or randomized search are common ways to explore different settings for complex ML models. But there are nuances here too, ways to be smarter about it. For hyperparameters that don't respond linearly, where a tiny tweak can have a huge, maybe exponential effect, sampling them from a log uniform distribution is way more efficient.
What does that mean, practically?
It means you explore the really small values and the really big values more thoroughly, because that's often where the optimal setting lies for those kinds of parameters. It's like finding the sweet spot on a dial that's super sensitive helps you pinpoint the best settings much faster than just trying everything evenly.
Got it. And for scoring, evaluating how good the model is.
Right. Instead of just looking at simple accuracy, did it predict up or down correctly, using log loss is a far more realistic scoring metric in finance.
Why is that better?
Because log loss accounts for the probability the model assigned to its prediction. And critically, it heavily penalizes high-confidence misses. If your model was really sure it was right, but it was wrong, log loss punishes that severely. It gives you a much truer sense of your model's real-world profitability and, importantly, its risk.
Okay, so now we have these really solid foundational pieces, right? We got pristine data, robust modeling techniques. Now we can really start pushing the boundaries. This is where the advanced applications meet the sheer power of high-performance computing, HPC. This unlocks possibilities that, honestly, were just unthinkable even a few years ago. Let's jump straight back to a crucial concept we touched on, the dangers of backtesting. You've heard us mention it, maybe hammer it home, and it really bears repeating. Backtesting done carelessly. It's like trying to navigate a really complex city just by looking in your rearview mirror.
Great analogy. Shows you exactly where you've been.
But offers zero guarantee about what's coming around the next corner. Most published backtests, sadly, are fundamentally flawed, usually due to selection bias, picking the one strategy that looked good out of hundreds tried and multiple testing.
The specific historical path you simulated is just one random path the market could have taken, not necessarily the most likely one going forward.
Which is why evaluating the probability of backtest overfitting, or PBO, is so critical. It helps you quantify that risk, the risk that your amazing backtest was just, well, a lucky accident.
Indeed. And to tackle this overfitting problem head-on, we can explore a pretty radical alternative, backtesting on synthetic data.
Synthetic data, so not real historical data.
Exactly. Instead of relying only on historical simulations, you use history to understand the market's statistical properties, its volatility, its correlations, how things tend to move. Then you generate a synthetic data set that matches those properties, but isn't tied to the one specific path history took.
So you test the strategy against many possible histories.
Precisely. This innovative approach lets you calibrate your trading rules, find optimal parameters, without just optimizing for one historical fluke. It dramatically reduces the chance of overfitting to past events. It's about designing a strategy that's hopefully resilient to a much wider range of future possibilities.
Okay, let's pivot slightly. Let's talk machine learning asset allocation, how we build portfolios. Traditional methods, like Markovitz's classic approach, they often struggle, right?
Especially with stability.
They do, particularly because of issues with estimating and inverting the covariance matrix. It's sometimes called Markowitz's curse.
What's this curse exactly?
The more correlated your investments are, say, stocks within the same sector, the greater the need for diversification becomes. But paradoxically, the greater the errors tend to be in estimating that correlation from historical data.
So just when you need the tool most, it becomes least reliable.
Exactly. It's a real problem. Hierarchical risk parity, or HRP, is a brilliant ML-based solution. It uses a kind of tree structure to group assets.
Based on how similar they are. Yes, based on their correlations, building up a hierarchy. Think like individual tech stocks grouped into the tech sector, which is part of the broader market. HRP achieves more stable, more intuitive allocations by recognizing these relationships. Crucially, it reduces the reliance on directly inverting that big, often error-prone covariance matrix. It's a really powerful way out of that traditional curse, leading to more robust portfolio construction.
Very cool. Okay, what else in the advanced toolkit?
Well, beyond just allocation, we emphasize the importance of detecting structural breaks in financial time series. These are sudden, often quite dramatic shifts in how the data is behaving. The underlying process changes.
Like bubbles forming or markets crashing.
Exactly. They can signal these explosive conditions. Identifying them quickly is absolutely critical for risk management. There are advanced statistical tests, like one called SADF, that are specifically designed as tools for spotting these pivotal moments.
Then there's this really fascinating concept using entropy features. Entropy, at its core, it's a measure from physics and information theory, right? Measures the level of, diversity or disorder.
That's the idea. In finance, you can apply this to things like the imbalance in an order book. Is it heavily skewed with buy orders versus sell orders, or is it relatively balanced and uncertain?
Or maybe portfolio concentration. How diversified is it really?
Precisely. You're turning a measure of chaos, or maybe predictability, into a potentially powerful predictive feature for your models. It can give you some truly unique signals that aren't captured by price alone.
Love that. Turning chaos into signal.
And building on that idea of unique signals, we dive deep into microstructural features. Now, this involves using incredibly hyper-detailed data. We're talking about fixed messages.
Fixed messages, what are those?
They're the raw messages that flow through the exchange's plumbing. Every single order placement, every cancellation, every partial fill, who was the buyer, who was the seller, who was the aggressor in a trade, down to microsecond.
Wow, okay, that's granular.
Extremely. And from this super granular data, you can derive incredibly powerful features, like Amihud's lambda that measures the price impact of trades, or VPI, the volume synchronized probability of informed trading.
What does VPI tell you?
It tries to estimate the probability that trades are happening because someone has private information versus just noise trading. It gives you insights into whether informed, potentially market-moving traders are active right now. This level of detail, it offers a window into the market's real inner workings that traditional, say, daily or even minute level data simply cannot provide.
Okay, and tying this all together, all these advanced techniques we've just raced through, complex data structures, sophisticated modeling, these microstructural insights, they all demand serious computing power. High-performance computing, HPC.
Absolutely essential. You can't do this stuff on a laptop.
Think back to the flash crash in 2010. Regulators struggled for months. It took them 5 full months just to produce a report. Why?
Right.
Largely because of the sheer data volume, something like 20 terabytes just for that short period.
The scale is immense.
And labs like Lawrence Berkeley National Laboratory, they really pioneered solutions here. They showed how HPC could dramatically speed up the processing, the analysis of these massive data sets.
Making sense of the flood.
So what does this all mean for you? The ability to process data at this extreme scale, to find those incredibly subtle signals in near real time, it's absolutely foundational if you want to be competitive in machine learning and finance today.
And HPC systems, they're built differently than, say, typical cloud systems. They often have these concentrated storage systems, specialized software, all designed to drastically speed up these complex calculations we've been talking about.
Like that VPI calculation you mentioned.
Exactly. Some HPC implementations can speed up VPI calculations by literally hundreds of times compared to standard methods.
Wow. So while cloud systems offer amazing flexibility, that flexibility sometimes comes with overhead, like virtualization, that can slow things down for these really time-sensitive, data-heavy jobs.
For these specific kinds of workloads, HPC often offers significant performance and even cost advantages. It's really about having the right tool, the right muscle, to match the intense demands of the job.
So, okay, let's try and wrap this up. What does this all really mean?
Yeah.
We've just unpacked pretty quickly the absolute crucial components for building genuinely robust, genuinely insightful machine learning models in finance, right from the ground up. And the key takeaway is this isn't just about grabbing some off-the-shelf algorithm and hoping for the best. It's a distinct, really complex field. It demands specialized techniques, a rigorous, almost scientific approach.
It's about meticulously designing and then operating that research factory we talked about at the start. Every step matters.
Exactly.
Which I think raises an important question for you listening. Are you prepared? Are you prepared to move beyond the simplistic models, maybe the easy answers, and really embrace the depth, the rigor that's required to truly understand and apply these incredibly powerful tools? Because in this field, maybe more than any other, knowledge isn't just power, it's your ultimate competitive advantage. It's really the difference between just watching the market ticker and genuinely understanding its pulse, its underlying rhythm.
Yeah. And the insights we've explored today, they really are just the beginning, aren't they? It's the start of a powerful journey into the future of financial analytics. So we really encourage you to think about how these principles, these ideas could fundamentally transform your own approach, your approach to information, to decision-making, and ultimately to your success in the markets. Lots to think about there.
You've just watched an episode of Deep Dive, our AI-powered podcast where two AIs explore the frontiers of finance, economics, and machine learning. If you found insight here, share it. If it helped you think sharper, like it. And if you want more deep technical conversations, subscribe and tap the bell so you don't miss the next drop. It's a podcast on how to apply AI and ML in finance and economics by two AIs, supervised by a senior portfolio manager from top-tier asset managers. Stick around. The future of investing is already speaking. Liked how that paper got decoded? We've spent 20+ years turning machine learning and AI into real-world tools, not just slide decks. Whether you want to implement a model, validate research, or build something from scratch, we can help. Explore our showcases to see it in action. Visit our site or contact us directly. Let's turn complex ideas into working intelligence together.